My name is Sayed. In this video, we will learn how to reduce your taxable income, and we will focus on three main ways, three main loopholes, three main tricks, whatever you want to call it, three ways to reduce your taxable income. So let's get started. So your taxable income divided into the different brackets. We can see if you earn up to 9,500. Let me just get this marking up here. So let's take a look at it. This one appears as a single person. We can see your bracket would be 10% if you earn up to this much amount, 9,950. If you earn more than that, up to $40,000, your taxable income would be 12%, and anything above this amount, your taxable income is 22%. So first, close to 10,000, you're paying about 10%. After this, up till 40,000, you're paying this much, and after 40,526 and up till 86, this is your tax bracket for 22%, and then after that, then you go into the 24% bracket. So more you earn, more you pay. And by the way, this video is for educational and entertainment purposes only, and this is for single person. We are talking, let's take a look at the merit filing jointly. This is first this bracket, 10% bracket up to $20,000, next bracket up to 20,000 to 81k, and 81 to 172k would be 22% bracket. So we are looking at different brackets, that what we are trying to do, how to reduce your higher tax brackets that we see this up here, and how can you reduce them by contributing into the 401k, IRA, and HSA account. So let's go into those accounts in more detail. Before we do that, let's take a look at example. If you earn 150k as a married person, your take-home salary would be 71%. You pay federal income tax percentage, your state income tax, your social security, all of those different tax adds up to the 71% take-home salary. And if you are filing as a single person up here, your take-home salary would be 64.89, close to 65% take-home money. So you paying higher tax bracket. And how to reduce this, that we will take a look at it with these accounts. 401k account is offered from your company. There are two different accounts: pre-tax regular 401k and after tax, which is Roth 401k. You can use regular 401k to reduce your taxable income. If you put in Roth, then you are not saving tax, you're paying upfront. But there are some advantages with that. But the reason why you want to use for regular 401k is to reduce your 22% bracket. Right now, if you are in 22% bracket, and or 24% or 32%, that is advantage. How much you can contribute? 19,500, and retirement age is 59, and penalty would be charged if you withdraw early. So that is the advantage you have putting in money into that. And also your company matching your some percentage. For example, some companies offer different percentage. So if you contribute 5%, they might match 5%. If you contribute 10%, they might match 10%. You need to check with your HR and see how much options you have available, and that is a free money on top of your how much you are contributing. And in 401k, you have an option of putting into the regular. Different market funds are available. Some of them are riskier, some of them are not. Some of them are same as the market, some of them are not. They are much more safe. So you need to consider that, do some research, talk to your financial advisors, and learn about that. Buy a book and take a look at it. And so that is, you can learn from that. So 401k, and next one is IRA. IRA is very similar. You have two different options: pre-tax, it's called traditional IRA, and Roth. Roth is after tax, traditional is pre-tax. and contribution limit is $6,000. You open it with yourself, go to any bank and open this, and with your IRA you can buy stocks and sell stocks with that, so you can earn some money. That is if you're putting in traditional IRA, you are putting some money and there is no tax consequences if you buy a stock, and if you have a profit of for example whatever percentage is, and you sell it on your IRA account, there is no tax penalty, but on the time of your retirement you pay tax on that. So you might say, okay, so if I pay tax on the retirement, you might be paying right now, right? What is the difference? Right now, if you're in 24% bracket or 22% bracket, you are on the higher bracket. You want to consider that you want to go to the lower tax bracket, and this is the reason you are putting in this money. And there are some some options. Right now, if you're in lower tax bracket, 10% or 12%, then it makes sense to put in Roth IRA, because you are you're not actually worried about too much higher tax bracket. This is a low tax bracket, and retirement age is 59, and penalty would be charged if you're trying to I believe it's 10%, and plus you have to pay taxes after you take some money out if you would do early withdrawal. So let's take a look at the one example. You can open IRA with the Fidelity, and they have traditional IRA, they have Roth IRA and rollover IRA, where you can contribute the money and do it at once or monthly or quarterly, however you want to do it. And rollover is if you have your old 401k with your company, you can roll over into IRA, or you can roll over into the 401k. So that is the option you have available with Fidelity, and there is no fees to do some transactions. So they don't sponsor this video. This is just myself. I'm just giving example that you can use this and use this as example. Next one is HSA Health saving account. That is the triple tax saving account. When you put some money into this, there is no taxes you pay, and you save tax on that. I believe it's 7,100 or 7,200 for 2021. And also if you have medical expense, you can take money out of your HSA. There is no taxes charged, and you can roll over your HSA into your own account, your separate account on top of your company's account. With 401k, there's the limitation, you cannot take money out, but with your HSA you can take money out of your own private HSA account, where you can buy and trade stocks. So that is a tax. This is a third tax saving you have. First, you take money out for the pre-tax, this one up here, and after that you can take out for your medical expense. There is no tax penalty. You don't pay any tax on that. And if you put some investments into HSA account, there is no taxes charged when you have your HSA grow. So that is a triple tax saving account. That is a tax-free growth with this account. So that is our that's how this is. A lot of people do not take money out for their medical expense. They just keep their receipts. They just have their HSA grow, and on the retirement time or after some time, they just take some medical expense receipts, and you can take your medical receipts after 10 years or 20 years. So that is the advantage you have. You can grow your money and keep your receipts and take the money out when you are retired, and you don't pay any tax on that. So this is one more example. You can open this HSA account with the Fidelity, and here you can see that they are mentioning some of the benefits. You can take a look at their website, take a look at it and read on that and more on that. So this is just one more example. So let's take a look at it. If you have with these three accounts, 401k, IRA and HSA, and one scenario without these accounts and one scenario with this. So for example, if you are making 150k and your standard deductions are $24,000 as a married filing jointly, so your taxable income, your 22% bracket would be this amount, 44,949, and you would be paying about 9,888 taxes up for this amount. And on other hand, if you have savings accounts like 401k and IRA and HSA, let's say you contribute up to 19,500, you contribute 6,000. For your IRA and HSA, you put 7,100. And by the way, on your IRA, you can contribute more, up to 12,000. So 6,000 for yourself, 6,000 for your spouse. So it'd be 12,000. But we just take example of this one, what we have right now. So your tax 22% bracket would be 12,350, and you will be paying taxes of 2,771. So you can see this amount up here we have is very less as compared to this up here. And how much you can save money on onto this is 7,171. Please don't mind my drawing up here. So 7,171, and so this is a tax savings you have in a 1 year. And so instead of you giving this money to IRS, you have this money and going in your pocket, and also you have your growth, you have some money into your 401k, IRA and HSA. So that is a benefit you have. And you can do also max out your IRA and in HSA and 401k. So that is advantage you can use. You can put your money HSA into your, buy some different stocks. You can also do with your IRA and 401k. You have a different options available as per the company you have your company offered you. So that is advantage you have. So pros, if you put your money into this, you have tax-free growth, meaning that if any of those accounts, you don't pay any tax. Only when you take money out, you have to pay tax on it. So by the time you get retired, it might be you're not taking out onto this higher bracket, 22% bracket. You might be taking on to the less 10% or 12%. Let's suppose you are married filing jointly, you're taking 81,000 or 100k. So you're still coming under 12% bracket. So that is advantage you have right now, you can use. So you have save on higher tax rate in the future. That is a pros. Con, so what is if you don't use this? So you might be paying higher tax bracket right now. You're losing on additional we just take a look at the example, $7,000 you're losing on this money, and in the future, and your tax bracket might be you might be lower. So that is advantage you have. So that is not gone. I think this is a pro. So thank you very much for watching. If you have any comments and what strategies you use, please let me know. Thank you very much. Have a good one.